Ladies and gentlemen, good afternoon. What I want to do in the later part of my talk today is to go through a whole series of companies and why I'm investing in those, particularly based on making sure that I have downside support when I invest in companies. As they say, if you look after the downside, the upside takes care of itself. But most of the talk I want to give on not asking wrong questions, the questions that are often asked in a conference like this. I want to talk about why speculating in commodities and why looking for leverage in mining companies and the incestuous and unwholesome relationship that exists in the mining among the mining investors when they combine speculation, commodity speculation with looking for leverage and the destruction of capital that they face as a result of it. What happens when people ask wrong questions is that they remove themselves from objective reasoning, they unhinge themselves from objectivity, and they entrap themselves in sound bites and slogans. A lot of mining investors consider themselves to be contrarians, but when they stand on sound bites and slogans, what they end up doing is that they exchange sound bites and slogans, and as a result must find comfort in blogs and herds. Now this is what I want to talk mostly about. A commonly asked question in a mining conference is, which commodity will do well in 2019 and in the near future? The real answer should be, I don't know, and I cannot know, and I cannot predict. However, if you did that, most of the conversations will come to a halt. Here is the problem. There are thousands of mines for every commodity on the planet. There are thousands, tens of thousands, maybe hundreds of thousands of consumers of those commodities and hundreds of millions of ultimate consumers of those commodities. Pricing, supply and demand profile of all these people is dependent on pricing, and that changes. Substitution from other commodities and the technology that is constantly changing in everything results into a massive discrepancy between what we can predict in terms of supply and demand and what actually happens. Pricing of commodities is set at the margin, and really it's not an easy job to predict the future prices of these commodities. Trying to play commodity pricing really does not work for most people. I have hardly really met anyone for who commodity price speculation works. Let's look at this graph of uranium price. I started working in this sector 13 years back. In this conference hall, everyone was talking about how uranium was going to become the way electricity would be generated on this planet, how uranium would take over electricity generation. Uranium price was exploding. Now the reality today is that there are fewer uranium-based electricity generating plants than there were 13 years back, and there are fewer today than there were 30 years back. However, because people are based on slogans and sound bites, they ignore the real facts. Then, out of nowhere, uranium price fell off the cliff. And you can see this on the very right-hand side, a very small dead cat bounce, which actually from the bottom of the recent few months is a 30% increase. But uranium bulls are already out talking about how uranium-based electricity will take over the world electricity generation. They forget the fact that uranium-based electricity is increasingly a smaller and significantly a small part of electricity generation as time has gone by. The same conference hall, there was a huge amount of talk about peak oil. No one uses peak oil anymore, but there was so much talk about peak oil. And they had actually very plausible sound bites. Supply was getting constrained because Mexico was unable to generate enough oil. Venezuela was reducing its oil production, and the Middle East was facing problems. On the demand side, developing countries were increasingly consuming more and more oil, and there was an expectation, a plausible expectation, that peak oil had been reached. Oil would go to the moon. Some people were talking about oil going to Mars and Jupiter. We all know where oil price is today. In nominal terms, oil price is lower today than it was 13 years back. In the last 13 years of my career in this industry, I have seen hysteria about virtually every single commodity. Coal, steel, copper, REIs. Hardly anyone talks REIs these days, but there were a couple of conferences in which the only topic of conversation was about REIs. No one knows about REIs these days. Now, I must continue talking about commodities because that takes up so much time and energy of so many investors and confuses and clouds their thinking. Data, which talks about manipulation of gold price, is, in my view, partly correct. The reality is that data believes that a lot more of electronic trading of gold happens in the market than the trading of physical gold happens. But ladies and gentlemen, that is the reality with most commodities today. Most commodities that trade on the exchange now trade 100 or 1,000 times more than the real exchange of physical commodity takes place in the marketplace. Now here is a massive irony. Electronic trade was supposed to have improved price information in the market. Electronic trade should have reduced volatility in the market. But what actually happened? Electronic trade brought in commodity speculators and hedge fund managers who have actually brought in a huge amount of noise in commodity price information. They have brought in a huge amount of volatility in the business, and at the end of the day, commodity price investors and hedge fund managers actually lose a lot of money trying to speculate in commodities. And not only they lose money speculating in commodities, they also ensure that legitimate investors and legitimate miners and legitimate physical traders of commodities lose money because these legitimate traders and legitimate consumers and suppliers must face volatility in pricing. The question stays, and I must keep talking about commodities because that consumes so much time for most people. The question is cobalt, copper, lithium going to increase in consumption over time? And the answer is absolutely. Consumption of absolutely every commodity has increased exponentially over the last few decades. Pay closer attention to this graph of how copper demand has increased over the last few decades. It has grown about 100 or 200% over the last 3 decades. But pay particular attention to the last 5 years. Copper consumption over the last 5 years has grown 25%. Now, for the planet, that's a massive increase in consumption of copper. Now, had I told you 5 years back that copper consumption would increase 25%, most people would have said copper price would go to the moon. What happened to the copper price actually? Copper price fell 35% during the same time period. Again, sound bites and slogans disorient people, confuses them, and takes them to a path in which they destroy their own capital. Let's move on to leverage. A lot of people focus too much on looking for leverage. Now, as I have said so far, that you should not really speculate in commodities. I have hardly ever met anyone who succeeds in making money is speculating in commodities. Avoid this business altogether. But if you must speculate in commodities, speculate in commodities, because by investing in mining companies as a vehicle for speculation in commodities, you complicate your life a lot more. Let me show that to you. Those people who look for leverage, what they expect is that when commodity or metal prices go up, the price of the mining company shares would go substantially higher. Let's look at this case of gold. Gold went up 85% over the last 10, 11 years. Now, what these investors in gold mining companies would have expected was they would have wanted gold to go up much higher than 85%. This is what happened to gold companies. They fell 47% in this time period. Copper fell 33% exactly when demand had grown hugely, but copper mining fell 53%. Uranium fell 40%, and uranium mining companies fell 85%. Those people who bought uranium mining companies when it was on the left-hand side of the slide have lost so much money that they have to increase their wealth by 500% or more to just break even. Basically, don't look for leverage in mining companies because they only offer anti-leverage when you go looking for leverage. Another question, another conversation that often happens here is about whether the market has bottomed or not. Every time I come, people think that the market has bottomed. This is the venture curve for the last 12, 13 years, and except for 2 years, the venture exchange keeps falling. My view is that forget about speculating in commodities, forget about looking for leverage, just try to do what mining investors should do, which is to look for the value in the ground, look for value in companies, and see if you can get it for substantially lower price than the value is. What I'm going to do now is I want to take you through a whole range of companies and how I want to ensure that my downside is protected when I invest in a portfolio. My portfolio should be independent of what happens in the broader market, and that's how I like to approach investing in these companies. Very quickly, some of the companies I want to mention, and we can talk about this 6 months or a year from now based on what happens. Keras Resources is a company with a market cap of £7 million. It has cash value of £12 million, offering you a 70% upside based on cash, and the company has promised to return shares that they own in the treasury back to investors. But on top of that, they have an operational project in Africa which is now undergoing trial mining. That gives you a full free upside based on your investment. In red, I have mentioned the problems I have with these companies. The company is not very responsive, so I want to keep asking myself, keep questioning whether they actually deliver on what they have promised so far. If not, I must be ready to dump my shares when time comes. Lorraine Copper. Lorraine Copper is trading for half as much as the cash value that company has. This company also has another project and royalty on the project that Sun Metals is running. Nkwe Platinum. This is a company which has a cash offer of 10 cents per share, and it's trading at 6.4 cents. Now, of course, there's an issue with the merger. There's some legal problems coming up probably. So this can get delayed, but when I'm waiting for a 55% upside, I am very patient. What I've talked so far is that I want to protect my downside risk. I want to make sure that my downside is well protected when I'm investing in these companies, which ensures that my portfolio is relatively independent of what happens in the broader market. G Resources is a company which trades in Hong Kong Stock Exchange. They sold their copper mine in Indonesia. They're sitting on 1.5 billion US dollars in cash. The market cap is only 1.3 billion Hong Kong dollars, which means that they have about 4 to 5 times as much cash as their market capitalization is. That's a huge amount of upside. Now, of course, the management can destroy that cash, and it seems they will destroy some cash of mine, but there's only so much cash they can destroy when it's 1.5 billion US dollars. Condor Resources has a market cap of $5 million. They are expected to receive more than 5 billion US dollars in cash. They have 10 other projects and they have royalty on the project. What is wrong with the company? I don't think the company does good marketing, and they might raise money at low price to keep the company going, which means that they might destroy my upside by diluting the shares outstanding. If that happens, I should be ready to move on and sell my shares. IDM Mining is here, and they are being acquired by Escort Resources. There's a 30% arbitrage upside, and you can actually book your profit by short selling Escort Resources if you want to. Okay, so that was all about where I approach investing by protecting my downside, by ensuring that there is something very solid in those companies which would protect my share price from falling too much. A few companies I want to mention which are value companies, which in my view offer value because purely based on what they have in the ground. I have a huge amount of respect for management of FPX Nickel. It's a company with among the largest nickel resources in the world. Market capitalization of this company is $15 million. It's a very well-connected management, and I think based on the new resources and metallurgical work they are doing, they should be able to improve their IRR and net present value. Amarillo Gold is another company that I have been invested in. It's a fabulous project with a very good IRR and very good net present value. What can go wrong with this company? The G&A looks a bit high to me, but again, having talked with the company, I understand that they have been doing a lot of work on the ground, and it's easy that they should have spent so much money, but I do really want to see the cash getting back in control. Globex Mining is another company that's here. It's a company with a massive portfolio of royalties and projects, but ironically, this company manages to raise money at exactly the wrong price, which is the bottom of the market. I don't know why they do it that way, but just one royalty of theirs is probably worth the market capitalization of the company. I'm really would like to see this company stop raising money when the market is at the very bottom, and make sure that what they do in the market reflects in the share price. Otherwise, stop spending money in the market. But there's a huge value there. Miramont Resources is a company with a project, a very large project in Peru. Again, a high risk, high reward project. A lot can go wrong, and your investment can surely go back to zero. As I said, these are few companies where the downside support might not be there. VR Resources is another company with two very nice projects which should give you a high risk, high reward situation. I want to close with mentioning two more companies that I don't really want to buy right now, and I want to mention why I'm not interested in buying these two companies. This company is Altus Strategies. Market cap is well supported by the cash the company has in the portfolio. The problem is that their G&A has been extremely high for my taste, so I want to see if they can control their G&A before I show interest in investing in this company with more of my money. AnaGold is actually quite a good company. I'm invested. I would be happy to buy more. There's indeed a big problem with the company. The book value is very high compared to the share price, which gives me a very good upside. But the company has to pay back a large loan, and the company continues to make losses. I hope they can turn the ship around and start making a profit. So, ladies and gentlemen, to conclude my talk, stop speculating in commodities. It does not work. Stop speculating in currencies. It does not work. Only for a rare person these things work. But if you must speculate in commodities, do not use mining companies as vehicles to speculate in commodities. When I invest in companies, I want to make sure that my downside is protected. As I said, I want to invest in companies where the cash or something in the company provides me downside support. I want to protect my principal. Ladies and gentlemen, thank you very much for your time.